Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and we are at the end of 2020. Pretty crazy year for everyone. So we want to take the time here today to give you a sense for what has evolved from the equity markets this year, what changes, what shifts we have seen, both from an equities perspective, but also from a volatility perspective for those of us that are options traders, and then really take some time to dive into what our expectations are for 2021 and addressing some of the concerns that investors may have about what 2021 may bring. So let's go ahead and get started. Before we get started, what we're going to discuss here is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So as we have covered here for the month of December, we've covered quite a few things, but for those of you that are new to OptionsPlay, you can sign up for a free 30-day trial at optionsplay.com. But this month we covered how to enhance your equity positions using options, talking about selling cover calls, selling cash secured puts. So as you're looking for some potential investment opportunities for 2021, and we certainly think that there are, using cash secured puts is one way that you could potentially start acquiring some of the positions that you're looking at, especially on some of the reopening trades, whether you're looking at hotel stocks, airline stocks, some of the reopening trades that you think are going to do well for 2021, using some of those strategies to go about doing so. We talked about longer term investing last week. We talked about some opportunities that you may see, especially in the cybersecurity space, as we covered in our thematic investment session last Friday, using some of these leap options or longer dated options to take advantage of these longer term views that you might have on an underlying stock or ETF. And leap options provide you leverage to be able to do so. And today, like I said, what we're going to do is we're going to do a quick preview of 2021 with a quick review of what we have seen here this year is to wrap up this year. We still have quite a few sessions before we break for the holidays, but that is the last educational session that we'll be doing here for this year. So today what we're going to cover is, like I said, we're going to do a brief 2020 review as to where the broader equity markets are effectively ending the year on, what changes we have seen from broader equity markets. Then we'll take a look at 2021 previews. And what I want to address is some of the equity valuations. A lot of investors are asking, how do you continue to invest when stocks are trading at these, what are effectively peak valuations? I want to address that and show you, if you look at it from a different perspective, how you might have a different view as to why valuations are so stretched and the fact that they could continue to get further stretched going into next year. And then we're going to take a look at an S&P 500 bottoms-up analysis. We're going to look at effectively what we expect S&P 500 companies to earn next year, and look at that within all the different sectors to get a sense for where the opportunities are for next year. And then we're going to look at some of the outperforming sectors, or sectors that we believe are going to outperform, sectors that we believe are going to underperform, and the sectors that we simply believe will perform on par with the broader market. So a lot to cover here today. Now, what the primary, I would say, question that I want to help investors answer from today's session is really, what should you expect from markets in 2021 and how should you position for it? That's really what I'm trying to cover here today. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what I'm going to be sharing with you are a series of technical research, but also some fundamental research. A lot of it I take from Bank of America. For those of you that have access to Bank of America research through a Merrill account, this is where you can learn some of the same tools that I have access to give you some sense for where we currently sit in the broader markets. And tomorrow morning, I'm doing another rapid fire session. Now, I do have some good news, not only for tomorrow, but for 2021, is that going forward, if you're a member, you no longer need to manually register for these events. So for tomorrow morning, if you're currently on a free trial, or if you're a member of OptionsPlay, you'll automatically be registered for this event tomorrow morning. You're just going to get an email before each event, about an hour before, with your link on how to log in so that you're able to log in tomorrow morning. But this is where we're going to be able to do a rapid fire session. A couple of Fridays ago, we did this. Over 500 of you submitted your symbols. We had over 500 submissions. I whittled it down to about 40 symbols that many of you requested. So we're going to be doing the same thing tomorrow morning. We're going to look at the top requested symbols, and I'm going to do some research and basically rattle through them live with you. Look at the charts, talk a little bit about the fundamentals, and what my views are for your top symbols. So I hope you'll join us here tomorrow morning. It was a fun event for me. I hope that it was informative for you. So I'm really looking forward to doing this again. Tomorrow, we're going to be continuing, because of the popularity of this, I think we're going to continue this into 2021. But again, the good news is that if you're a member, you're automatically registered for it. You don't have to do anything on your own to do so. So with that, let's talk a little bit about 2020. So I actually remember the start of 2020. On January 2nd, the first trading day, I was on Squawk Box at 6 a.m. on CNBC. And on that day, I got asked a question from Joe, what I thought markets were going to do in the first couple of months or first quarter of the year. And I said that, markets were a little overstretched, were a little overbought, because we had already spent at that point a couple of months, where the equity markets were just slowly grinding higher without any real pullbacks. RSI, as you can see, was overbought for quite some time by that time. And I said that markets were due for a pullback sometime in the January to February timeframe, just because of where we were currently sitting from positioning perspective. Now that sell-off didn't materialize until late February, but obviously I had not predicted, number one, COVID. I certainly did not predict the magnitude of it, but that is largely what we saw from that. But markets relatively recovered fairly quickly back to the January opening high, which is around 323 or so. We recovered back to that level right here in very early June. After the February sell-off, markets returned back to the 323 level, which is where we opened the year on, sold off, reclaimed that level back here in late July or so, and since late July, continue to rally. Came back to retest this level multiple times in late September and late October, before breaking out higher recently on all-time highs, above all-time highs that it put in back here in September on the news of Pfizer and Moderna's vaccine clinical trials were showing very positive and looking like we were going to get a vaccine within a few weeks. And ever since that, the markets have continued to drift higher here. Now, I will say that where we currently sit kind of remind me of where we were sitting back on January 2nd when I started the year, saying that markets were slowly grinding higher. We were overbought. We were not trying to fight. I was saying that you shouldn't fight the Fed at that time. And largely, we are still in the exact same position that we were in back in December of 2019, December 2019. I feel that we are in a very similar position that we are in. And the view here is that, December 2019 was a fairly strong year for the equity markets. Now, 2020 also has been a fairly strong year for the equity markets, given the fact that we went through a global pandemic. But the one thing that I want to point out that has largely blown something out of the water here is the fact that the S&P 500 for the year of 2020 is up roughly 15% year to date, from January 2nd to where we are today. And I expect that markets may continue to grind higher, maybe up to the 380 level here by the end of the year, a little bit higher. So maybe closer to 17% higher here for the year. But if you look at the NASDAQ 100 index, I didn't think that we were going to get this kind of outperformance. We're talking about 3 times outperformance of the NASDAQ 100 versus the S&P 500. We're talking about 45% gain to the upside on the NASDAQ versus 15% on the S&P 500. That's worlds apart. We have never, ever seen a major index like the NASDAQ versus the S&P 500 outperform one or the other. It's such a significant level here. And this really speaks to, what COVID-19 has started to accelerate what was happening even before the start of the coronavirus. Some people will say that this is due to the COVID. I don't necessarily agree with that per se, because the NASDAQ outperformed the S&P 500 last year by about 10%. And this is really just simply moving us in this direction of what is a technology dominated world. Especially with the NASDAQ 100, it doesn't include financials, doesn't include any energy stocks. That, which is largely drag the S&P 500 lower, does not have the same problem here for the NASDAQ. Now, the NASDAQ obviously recovered back to its highs or its January highs back in as early as mid-April, and is basically not look backwards since then. We did have a bit of a pullback here, a little bit of underperformance here for a couple of months from September to November, but now we've recently had the breakout here above the $300 level here on QQQ, which has been a major resistance level, but recent breakouts here have basically confirmed that level as a breakout level, and we're basically targeting 320, 325 here to the upside by the end of this year. This is really where we currently sit in terms of the broader markets. And this shift, my expectation is that it's likely going to continue into 2021. Another shift that's also important to remember here for 2021 is actually small caps. Small caps took all the way through, as you can see, this is January 2nd. It didn't get back to January 2020 highs until basically mid-October. Small caps have been a large underperformer of the broader markets. But ever since that it got to that back level, came back to test that level a couple of times. And in early November, this is when the Pfizer vaccine came out, has really gone through the roof. As you can see, basically in the beginning of November, we were still back at January 2020 levels. But since that time, small caps are up 20%. Small caps are up 20%. So we're talking about small caps outperforming the entire year of S&P 500 in just the last couple of months. This is the rotation that we're starting to see into value in 2020 that also, in my opinion, will likely continue in 2021. So those are the major shifts that we have seen from the equity markets here this year. But the one other shift that I think is important for options investors to pay attention to is the shift that we have seen in volatility regimes. So prior to February of 2018, this is a chart of the VIX. The VIX was getting compressed and compressed and compressed into the low, the eight. We were getting down to the 8 level here on the VIX, which is something that historically we have never ever seen. This is what we saw back here in late January, early February of 2018, until we had what we call now Volmageddon, where the VIX effectively doubled in a single day, and all of the short volatility ETNs out there basically blew up. We had some funds that had about close to $2 billion effectively get their entire value erased in a single trading day due to the shifts that we had saw in volatility. So this was a major, I would say, event in shifts in volatility, because ever since that Volmageddon day, we have never seen VIX get below about 12 or so since then, because markets have basically said, we need to be careful from ever entering that type of volatility regime again. And from February of 2018 all the way through the beginning of the coronavirus, we largely saw VIX somewhere between 12 and 24 or so to the upside, really range bound between these two levels. Now, obviously, COVID, big shift to market uncertainty, big shift to where we currently go in the equity markets. So during this COVID-19 pandemic, VIX basically got repriced again, right? So first, this was pre-Volmageddon. After post-Volmageddon, we had a new shift in terms of volatility shifting higher. And due to the pandemic, this is expected. There was a lot of uncertainty in the markets. We had no idea, how long this was going to last, how deadly it was. It really wasn't until late summer before we started to get a good sense for where economies were going to be. But, largely what we saw here is another repricing of volatility from about the 21, 22 level into the 40 level or so. So this is what I would call the COVID-19 pandemic volatility regime. And now that we've hit the end of November, there are a few things that have shifted now. We have had the a presidential election. We know who is going to be the president. We have the Electoral College that have now certified the election, which means that we're likely going to see a peaceful transfer of power. We have vaccines that are out for distribution already. We have 2 more potential vaccines that are going to likely get approved again for distribution. There are distributions of other vaccines like the Chinese vaccine, the Russian vaccine, globally already in different parts of the world. So vaccine distribution is already underway across the entire globe. So this also speaks to a new uncertainty or less uncertainty compared to what we saw during the COVID pandemic. So now we have what I would say is a new volatility regime that we're entering. And, what is it going to look like 2, in my opinion? Probably not quite the same as 2, but largely I would argue that it probably looks much similar to 2 than 1 or 3. And it'll probably somewhere maybe a little higher, lower level here to the downside, maybe 13 to 14 to the downside. And then maybe somewhere in the 25, 26 to the upside is largely what we will see. Now, will we see spikes above 25, 26? I certainly think that's that is number one going to happen, but largely we're going to see VIX, in this kind of level here to the upside. But the one thing I also want to point out here is that, as you look at the VIX for your trading, VIX may not be the best index for you going forward in terms of understanding volatility because of what I just showed you here before. When we look at the S&P 500 versus the NASDAQ, where are you going to shift your portfolios? What do portfolios look more like these days? Does it look more like the NASDAQ 100 or does it look more like the S&P 500? From my perspective, I think more and more portfolios are shifting towards a NASDAQ 100 type portfolio, a more tech heavy, tech focused portfolio going into 2021. So the question is VIX even the right measure? Because the VIX is the measure of the S&P 500 index options of implied volatility. So, one of the things that I want to point out here is that going forward, there is now a new NASDAQ 100 volatility product called VolQ, which is the NASDAQ 100 index volatility. So it's basically at the money NDX options that are used to calculate VolQ. It has the same characteristics as VIX. As you can see, the chart almost looks identical to the VIX, but what it does is it tracks the implied volatility of the NASDAQ 100 versus the S&P 100, which is important when you're looking at these indices of volatility indices to make sure that you're using one that largely follows the portfolios that you're actually trading. So those are some of the things that are new products that you should be aware of as we go into 2021, as we see this shift that we have seen in portfolios this year. Great outperformance of the NASDAQ 100, which means that we're seeing more and more portfolios shift towards that performance rather than towards the S&P 500. So those are some of the things to look at. Those are some of the things to remember what we're currently seeing here in 2020. So let's now look a little forward. Let's look at 2021. So let's first take a look at the outlook itself. So at a very high level, number one, the 2021 outlook so far is looking fairly strong. But the first half, in my opinion, is where the risk actually is, because at the moment we are still seeing a rise in COVID cases, right? We have not bent the curve just yet. We're seeing states and cities still go into lockdown. The vaccine is still in the early days of distribution, meaning the vast majority of the population is not receiving it in the first couple of months, the first 3 months of the year. So during that time, that's still going to be a very challenging time from an economics perspective. From an employment perspective, services jobs we're going to see more services jobs being lost in the next few months. Job gains is slowing down. It could potentially start turning negative again if lockdowns become more severe. But the second half is really where the picture gets a little rosier. So when we look at 2020 expectations, even though they're positive, we might see some weakness in the first half and then followed by a much stronger second half here. So That's our primary view here for 2021. Again, value over growth is something that we are expecting for at least the first half of 2021. We think small caps is likely going to outperform some of the mega cap names here in the beginning of the year. That could start to turn around here in the second half of the year. But those are some of the things that we were paying attention to. Value over growth, small over large is our preference here going into 2021. And I do think that 2021, we're going to start to see a lot more interest, a lot more focus from investors in green energy. Everything, when we talk about ESG investing, environmental and social, will become a larger focal point for investments. This is something to remember, and this is part of why, for the first month of January, the two thematic events that we're going to be hosting for our members is going to be on clean energy, renewable energy, and electric vehicles. We want to start bringing this focus of investors that are focused on the environment and showing you which sectors to focus on, which specific companies within each sector to focus on. So those are some of the things we will be bringing you in January 2021. But green focus is certainly going to be one that investors are going to pay attention to. A lot of the gains we have seen this year have come from clean energy and renewable ETFs. So this is a trend that we expect to actually continue to accelerate into next year. Now, the downside risks that we see are some of the ones I just discussed. Number one, vaccine execution is a big one. So far, we've only had about a week of Pfizer vaccine distribution. So far, things have been pretty good. No major hiccups. We also have not seen any significant adverse reactions from anyone from receiving the vaccine. So vaccine execution risks are really, in my opinion, some of the large ones. Number one, as to whether the distribution goes as smoothly as we expect it to. Right now, it's going to predominantly major cities. As we get into the more rural areas, that may be an issue. Whether or not the general public, what percentage of the general public are even comfortable with taking this vaccine is another big if that we currently have to contend with. Stimulus delays. We've been talking about, hey, stimulus is just around the corner for a couple of months now, or more than that, 3 to 4 months now. We've been expecting that second round of stimulus, and it's still not done. Now, even though over the past couple of weeks, it looks like we've made progress, looks like we're just at the finish line, but I really feel like we've been saying that for quite some time. And maybe a stimulus is certainly looking smaller than what we had originally anticipated. Back 3 or 4 months ago, we were looking at about 1.2, 1.5 trillion. Now we're talking 900 billion, and what could be signed as low as maybe 700 billion. So significantly lower in terms of stimulus delays. And when you have a deceleration in the economic picture that we're currently looking at, and the stimulus delays in a smaller stimulus, that could have a lower impact, if you will, on the recovery that we'll see in the first half of 2020. And again, longer and more severe lockdowns is another downside risk here, at least to the short-term economics of the recovery. We've already seen the initial claims and unemployment tick up 2 weeks in a row at very high levels. We've seen employment gains come down significantly lower than what are expected, only adding about 200 something jobs last month. 200 something thousand jobs is what we would normally expect in a normally functioning environment, not in an economy that's booming or coming back into a recovery. So those are some of the big concerns that I have here for early 2021. And these are some of the downside risks that I see going into February, going into March, as the lockdowns are going to flow into the economy and some of the economic numbers that we start to see. So that's the risk that I currently see for 2021. And I want to address one of the major questions that I keep getting from investors, which is really valuations. If you look at valuations for most traditional metrics like PE ratio, price to book, price to sales, any of these types of metrics, we are trading at peak valuations that we really haven't seen since the dot-com bubble. But I would argue that this is in a very different environment because we've never had ultra low interest rates globally in the same way when we look at valuations. So when we look at valuations historically, they were always in a higher interest rate environment. So in the interest rate environment that we're currently in, I would argue that yes, valuations are high, but they can actually continue to go higher because because money is effectively free to borrow. And for that reason, valuations really don't mean a whole lot. But if you look at yields, that is something that you can't just walk away from. And that's really, that's something that actually means something. That's actual money in your pockets from yields. And the one thing that you want to take a look at is the ratio of S&P 500 yields compared to the 10-year yield. Now, this expansion that we have seen this year in terms of yields of S&P 500 stocks significantly higher than 10-year yields is not because S&P 500 dividends are any higher. It's just because US Treasury yields are so low. Now, when you have such low and persistent low interest rates, in order to seek any yield, the only place that you can really get it these days is in equities. And that's why we continue to see valuations get further and further stretched, because there's nowhere else to get yield. So you're getting the capital appreciation from the equities. You're getting substantial yield compared to the S&P 500. Right now, we're still around 2.5%, 2.5 times the yield that you get from S&P 500 stocks versus a 10-year Treasury bond. For that particular reason, stocks look very, very attractive from a yield perspective. And look at this chart here on the right. 70% of S&P 500 stocks have a higher dividend yield than the 10-year Treasury bond. Now, when we look at 10-year Treasuries, yes, they are less volatile than the S&P 500, so it's not a fair comparison, but TLT is not that much less riskier or less volatile than the S&P 500 right now. So that's one of the reasons why when you compare the two and you see one segment of the market, equities, generates significantly higher yield than what is a safer asset here on the side. But when markets are recovering and you're no longer looking for safety, or you're not trying to find safety in treasuries, you're going to continue to put your money into equities. And for those reasons, I genuinely believe that despite we're trading at peak valuations, there's no reason that valuations can't continue to get further stretched. So that is not a good reason to sell equities. It's not a good reason to short equities just because valuations are stretched. And I know that that's hard to wrap your head around, but in the current market environment, you just can't compare valuations today to where they were in history, because we've never been at such ultra low interest rates compared to history. And the other thing that I want to point out here is that the current valuations in the grand scheme of things is not actually that stretch. If you look at normalized PE here, we're currently at about 22 times normalized PE. We have seen stretch valuations as high as 32 times, roughly since 1987. So, with that in mind, there is a very strong correlation between where we currently are in terms of normalized PE versus what the long-term average of returns for equities over the next 10 years are. Now, 10 years is a long time, right? So not everyone here on this webinar is trying to invest for the next 10 years. But for long-term investors, where we currently sit, number one, the R-squared ratio is 79%. Very, very high correlation between normalized PE and 10-year returns. So again, 10-year returns is a long time, but very, very high correlation. Almost no other valuation metric has anything close to an 80% correlation to future returns. But the normalized PE to 10-year returns is one that has very strong relationship. And right now, this is looking at about an average of 5% per year over the next 10 years at the current valuation metrics, meaning we're not at the extreme levels where our expectation over the next 10 years is turning negative. It is right smack in the middle, if you will, from a normalized PE perspective. So with that, I think what we want to do is we want to take a look at, the S&P 500 from a bottoms up perspective. So here is the S&P 500 earnings per share, meaning if you own one share of every single S&P 500 stock, how much would you have in earnings at the end of the year? And what we have seen in terms of expansion from 2015 to 2019. So 2018 to 2019 was a very flat year. We went from $160 a share to $162 a share. And then 2020 was obviously a big decline because of the COVID-19. So we had about a 16% decline in total S&P 500 earnings from 2019 2019 to 2020. Our expectations now for 2021, from a consensus perspective, this is looking at all the analysts on the street, they're looking at about a 23% return back here. So if you're down 16%, 23% gain just basically brings you back to break even here, right? So basically you're getting from 162 back to 167. So you're just slightly higher than break even from where we were in 2019. That's our current expectation for 2021. Now, that is what, if you add up all the analysts on the street, Bank of America currently has one that's slightly lower at 165. So if you're looking at 165, 167, you're looking at basically a modest gain from 2019 to 2020. Now, again, 2019 and 2021 is a little different because we are having multiple expansion because of the fact that you have lower interest rates. That's going to, generally speaking, have equity markets will trade at a higher multiple. So even if earnings are the same, you would trade at potentially a higher multiple. So the S&P 500 would trade at a higher level here. But when you break down the sectors, this is really where it starts to get a little interesting, right? Where did we see some significant moves to the downside? And the one surprising one that I think for many investors, you might actually see that consumer discretionary down 32% in terms of earnings. So consumer discretionary, we consider this one of the strongest sectors of the markets right now, but in 2020, down 32% in terms of earnings. We do expect a pretty strong rebound of 50% in 2021, which basically, again, brings us back to where we were in 2019 here. That's what the street's estimate is. Bank of America, a little less aggressive here, only expecting a 30% return here in 2021. So consumer discretionary is one that we are somewhat bullish on, but not particularly that strong. Some of the other ones that are, I think, worth taking a look at is energy. Energy, made $52 a share in 2019 in terms of earnings, but lost $4.7 per share. So over 100% decline in earnings. Now, this is expected to recover back up to about $21 a share. So roughly a little less than half of what the S&P, what it was earning in 2019, but a very large bounce from where we were. If you look, from where it was here in 2020 into 2021. Another one to look at is financials. Financials took a big hit here in 2020, but expect to see a bit of a modest bounce here in 2021. Healthcare, same thing. So healthcare actually grew in earnings in 2021 and is expected to continue to grow in 2020. Grew in 2020 and expected to grow in 2021. Industrials took a big hit, but is looking to see a big bounce here back in 2021. This is one that we did expect. Industrials usually takes a big hit in years of a recession. Some of the other ones, communications, largely flat here for 2020. Looks like it's going to see some modest uptick in 2021, but real estate and utilities, as you can see, declines, basically flat both on the year, but also expecting virtually very little growth here going into next year, similar to staples. Staples, as you can see, basically flat on the year. Expectations for next year is really not much higher here, certainly well below, the S&P 500 expectation of growing about 23% in terms of earnings. So that's kind of when we break down the S&P 500, which companies or which sectors have actually made money in 2020, which sectors have lost money in 2020, and what our expectations are for next year. So looking at the sectors overall, so we wanted to point out some of the sectors, some of the highlights, if you will, that we are fairly positive on next year. So first, looking at sectors that we think are going to outperform. First one is financials, and I purposely put the ones that maybe are not the top of mind for every investor. Financials. The reason that we really like financials is because of the fact that financials from a balance sheet perspective are fairly strong, and they are at this point fairly undervalued. Even with the recent gains, upticks that we've seen in XLF or KRE or any of the financial ETFs that you follow, and we've seen that expansion in PE, even with that expansion, they're still fairly undervalued. Most of these major banks are trading at 10, 11 times earnings, so relatively low compared to historical, and they have historically a very, very low amount of debt. So they are a lot less risky than they were back in 2007, 2008, 2009, 2010. So stronger balance sheets, lower valuations. That is the flight to quality that I think we're going to start seeing in 2021. This is also a sector that, generally speaking, is going to have a strong benefit from the reopening and the recovering of our economy. So XLF, slow on the recovery, but I think as we get back into a stronger recovery in the second half of 2021, financials is certainly going to be one of the sectors that will outperform. And rates here may provide a bit of a tailwind here. So, the Fed has kept its current bond purchasing, the same based on the meeting yesterday. But this is actually one of the risks, because if the Fed does step in and keep interest rates lower, especially on the longer end of the curve, where we have seen that steepening of the rate curve, which has provided a tailwind for financials. If we do see that rate curve start to flatten a little, that is one of the risks that we see here to financials. So, as we look at the financials, this is one of the segments of the market where the Fed policy does have some potential gains or downside risks to this particular play. So this is one that you have to pay attention to from a Fed policy perspective. The other one that we wanted to take a look at is healthcare. Healthcare, as we showed you before, actually increased in terms of profits for 2020. Some of it due to the pharmaceuticals that have made more money this year in 2020 versus previous years. But also, if you look at the sector overall, this is a sector that is likely going to do fairly well in a government where you have a Biden with a split government. There were a lot of concerns that Biden with a Democratic government was going to be a net negative for this particular sector, but Biden with a split government is actually a bullish outcome here for this specific sector, because a lot of the more drastic Obamacare expansion or ACA expansions that the Democrats wanted will not likely be able to pass, and that is generally a net positive for a lot of the insurance companies and the major pharmaceutical and drug companies in this particular space. And healthcare largely is still relatively inexpensive from a valuations perspective, and they also have very strong fundamentals. If you look at the healthcare sector, as I was showing you before, still generating a large amount of free cash flow, and right now is not seeing the decline in earnings the same way some of the other sectors have. But the risks here that we still see here to this particular sector is, some of the drug price reform that the Democrats or rather more bipartisan support is there is for drug price reform, as well as any of the healthcare reforms that the Democrats are trying to push for. Those are some of the risks that we see here with looking at the healthcare space. The two other ones, so technology is really one that is no surprise to anyone to be on this list of sectors that are expected to outperform in 2020. This is purely based on fundamentals. Technology stocks generate a strong amount of cash flow. They have extremely high margins, and just generally speaking, the fundamentals look strong here for the technology stocks. There's strong thematic opportunities, everything from cloud to the fact that we've seen a significant shift in working from home to robotics to even onshoring. Right now there's due to the tariffs and the trade wars and even due to COVID, we've seen a lot of companies try to bring manufacturing back into the US, not relying on global supply chains because of the breakdowns that we have seen in global supply chains this year. That has driven a lot of technology automation. So there are a lot of specific plays within technology that look extremely encouraging for 2021. So for those reasons, technology remains one of our top picks for this year. But the risks to the downside in this particular sector really is the tech wars with China. Just because Biden's in president does not mean that we're not necessarily going to see continued, let's not call it a war, but conflicts with China on the technology front, everything from semiconductors to some of the emerging technologies that we rely on. Those are some of the concerns that we have here for technology, but also, the lawsuits that we're starting to see against Facebook, against Google, against Apple and Amazon, anti-monopolistic lawsuits. These are ones that are likely going to cause some downside risks. The risks are low, But these are some of the things that I think may have investors a little concerned about continuing to invest in these types of companies that have driven a lot of the gains that we have seen out of the NASDAQ 100 going into next year. So this is one that is at risk, but it's one that right now the fundamentals still look very strong. The one sector that is probably not on your radar, and largely, I have not been particularly bullish here on the energy sector, but there can be a case that could be made for energy. Now, this is one that I'm on the fence about myself. And from my perspective, it's not one that fits within my investment thesis, but I wanted to make the case for investors that do want to look at this particular sector or this particular segment of the market as a potential opportunity, because there are some, I would say, valid reasons for, number one, energy is currently extremely cheap from a valuations perspective, and it does generate, XLE generates 8% dividend yields. It's hard to walk away from an 8% dividend yield. It's hard to say, that's not attractive, for a long-term investor, or even for a short-term investor who thinks that energy stocks are just going to stay where it is. So if I collect 8%, I'm a happy investor. So for those reasons, I do think that for certain investors, if this fits your risk profile, worth taking a look at. Some people, as right now, as far as whether or not the 8% dividend yield will be able to stick, that's the main question. For it seems like analysts, and so far we have seen it throughout 2020 that dividend yield has held. There were a lot of concerns in June and July whether energy stocks will continue to be able to pay these types of dividend yields. And we're now at the end of the year and they are still paying these dividend yields. So and oil prices have largely at least recovered and stabilized. They have the potential of grinding a little bit higher from here. They don't look like they're going to go significantly lower from here. So for those reasons, this is one sector that I do think has some merit as far as why it could outperform in 2021. And it seems like energy companies have refocused their attention on generating free cash flow, as I was showing you here before. The energy companies look like they're going to be generating positive cash flow for 2021. There is an uptick right now in terms of demand. So those are also reasons why some investors are looking back into energy. And the risk really is still on the environmental side. There are a lot of investors that are starting to shun oil and gas companies. Bank of America has committed to no longer funding any type of oil and gas exploration. So, when you have big financial companies that largely have funded the expansion of oil and gas say, we no longer want to continue to fund this particular industry because of the environmental and social issues, that has major impacts in the long run. So energy, for those reasons, I don't like it. But for investors who maybe, if ESG is not something that you necessarily care about, you want that dividend yield, there can be a case, in my opinion, made for energy. Now, to look at some of the sectors that we believe are going to underperform the market, and I want to stress, this is underperform, which is different than bearish. Bearish means that I think this market's going to go lower. I don't necessarily know that these sectors are going lower, but what that means is that if the market goes up, let's say 10% next year, and these sectors go up, 3% next year, that's a market that's underperforming. That's different than to say that this sector is bearish, okay? So I just want to clarify, underperform and bearish are two separate things. So these two sectors we believe are going to underperform is real estate. Real estate is one because this is really where the largest number of dividend cuts, you would think is coming from energy. It's not. It's coming from real estate. That's where the most dividends are being slashed. And this makes sense from a fundamentals perspective. These are the companies that are no longer able to generate the same type of yield that they were real estate companies. Now, I will say that within real estate, there are a few slivers of subsectors within real estate that are doing fairly well, especially the ones that are in the real estate investment trust in cloud computing, like digital realty. There are also, the self-storage companies are doing okay right now. So, you have some subsectors within real estate that are doing fairly well, but commercial and residential real estate are really the ones that are suffering the most. And we're going to likely see substantially less demand for some of these REITs in 2021. So for those reasons, this is one of the segments of the sectors of the market that we expect to underperform. But the risk of reopening being stronger than expected is really one of the potential upside risks, if you will, to real estate. If, let's say, the vaccine distribution gets is fairly smooth. We get it out to, a very large percent of the population sooner than we expect. Maybe by March, we have 70% of the population vaccinated, and largely we have kind of eradicated COVID from the country, or maybe even globally. That is where we do expect real estate to outperform the broader markets. But that picture is less likely than what we're expecting to see, or the base case that we're expecting for 2021. Consumer staple stocks is another one that we expect to underperform. And consumer staples has underperformed the broader markets throughout 2020, so it's not new for it to continue to underperform in 2021. But really, this comes down to the fact that a lot of people have stocked up during COVID, and this stock up is really going to start putting a dent or diminishing demand in 2021. Unlike services, where you can't stock up on services, you can't stock up on haircuts, you can't stock up on restaurants, going out to restaurants. As things reopen, people are going to shift some of their spending in consumer staples and consumer discretionary towards, travel, towards entertainment. So for those reasons, consumer staples, especially as COVID vaccines start to get distributed, these are ones where you might just see some downside, some underperformance here. But consumer staples at the moment is fairly inexpensive, and it does have fairly strong fundamentals. So for those reasons, I'm not bearish on this particular sector. I think it's just going to underperform the broader markets for consumer staples. And as far as sectors that we think are just simply going to perform on par with the markets, and materials and industrials, these are sectors that we believe are strong performance right now, are going to likely continue to be strong performers, but we don't necessarily think that they're going to outperform the broader markets here. Both industrials and materials have fairly strong cyclical tailwinds, meaning these are sectors of the market that generally perform well during an economic recovery. In industrials, in the investments to reshore, bringing manufacturing back onto US soil is certainly one of the things that is likely going to outperform, in my opinion, industrials over materials. So between the two, I actually think industrials are likely going to be a little stronger than materials. The clarity around tariffs, so with Biden as the president, we do believe that we're going to see more clarity in terms of perhaps even rollback of tariffs, and we believe that that's going to unleash some capital expenditure in industrials, which is likely going to capture further upside for long-term investors. But the risk to industrials is really aerospace. 20% of the industrials sector is in aerospace. This is where the recovery of the aerospace sector is still very much unclear right now. Where is air travel going to be 1 year, 2 year, 3 years from now? Leisure travel, we certainly expect by 2 to 3 years will likely return back to normal, but corporate travel is unlikely to ever return back to where it was prior to the pandemic. And that is likely going to provide a bit of a drag here on the sector. So for those reasons, industrials has that risk that materials does not. And materials right now, is really doing well because of rising commodity prices. Look at stocks like FCX, NEM, any of the mining stocks doing extremely well and likely going to continue their outperformance here next year. And just the strong relative strength and momentum we've seen in materials is likely to continue here next year. But materials have reached what we consider fairly stretched valuations, and it's fairly euphoric, if you will. A lot of these stocks are very overbought. Now, that doesn't mean that it can't continue to be overbought, but the risks are a little bit skewed to the downside. So for those reasons, that's why these two sectors are not in the outperform section and they're in the market perform section, because they are at these fairly stretched valuations. And markets are kind of a little over positioned, a little overweight these particular sectors, and we might see some profit taking into next year. And lastly, consumer discretionary and utilities. Consumer discretionary, continues to be strong here, but we do see some concerns. Consumer discretionary, it really comes down to e-commerce unlocks a lot of efficiencies, but the thing about consumer discretionary is that Amazon now is 40% of the consumer discretionary weight. And that is a big concern when one single stock, and I don't think we've ever seen a single stock get to this type of weight. 40% of the consumer discretionary stock is now Amazon. As we shift into e-commerce, this certainly locks a lot of efficiencies, and Amazon has benefited from that. But Amazon is getting a little perhaps too large, and we do have that the lawsuits that are currently happening that have bipartisan support that want to break up some of these big tech companies. Those are some of the concerns that we have in terms of these the extreme moves that we have seen to e-commerce, and whether or not that's going to stay, because there is some pretty extreme positioning in some of these e-commerce stocks. They're trading at eye-watering valuations that really, have no matter who you are as an investor, you're going to have some trouble wrapping your arms around, the valuations that these e-commerce stocks are currently trading at. So for those reasons, there are some downside risks, and that's why this is in market perform and not an outperform. Right now, elevated income levels and low credit card delinquencies continue to add to the gains here that we see in consumer discretionary, but those are some of the things that we see that we expect to pull back in 2021. And, the strong housing markets and working from home trends have increased household spending away from travel and entertainment. Those are also things that we expect that tide to turn a little in 2021, only in the second half. But for those reasons, in the second half of 2021, we actually expect consumer discretionary to weaken a little. So again, that's why it's in market perform rather than outperform. And lastly, utilities. This is one segment of the market that we would normally expect to be in underperform, but it trades at very inexpensive valuations, and the dividend yield right now is not only very stable, it's very strong, and especially if you compare it to the 10-year yield, utility dividend yields are extremely stable and extremely strong, unlike real estate where we've seen significant declines in dividend yield, and that's what knocked real estate into underperform and kept utilities at market perform because those dividends are stable. We have not seen any decreases in terms of earning power in terms of utilities. We don't expect any major shifts in utility earning power next year. So for those reasons, it's basically in market perform. But the risks right now to utilities, the same risks we see in real estate, is a rise in interest rates. Now, we don't see that at the moment. We can see some rise in inflation, but those are some of the reasons that we could see utilities perhaps underperform if we start to see a big rise in interest rates here for 2021. So for those, that covers what I wanted to share with you here for 2021. That's our expectation going into next year. A lot of interesting shifts in the market that we have seen that we expect to continue into next year. But as we start to recover, there's going to be different sectors that we want to start paying attention to here for next year. So with that, I want to thank our members for supporting us and allowing us to take the time and do this type of research and present it to you so that you guys have a better understanding as to how to position yourself in this market, especially for next year. And I just want to, again, thank our members. So if you want to sign up for a membership, which would give you access to the rapid fire session that we're doing tomorrow morning, you can do so using the link I just sent to you in the chat window. And if you've never signed up for an OptionsPlay event before, and this is your first time, you can sign up for a free trial at OptionsPlay.com, which I just posted again into the chat window. And again, just to remind everyone, tomorrow morning, I'm doing another rapid fire session. This is where we take your symbols and I look at them. We take all of the popular symbols, I research them, I present them to you, and I show you what my views are, both from a technical and a fundamental aspect, if I do have a fundamental view. And again, one of the big shifts that we've done here is that you, as a member, you no longer have to register for them. We're automatically registering. So if you're a member, if you're on a free trial, you'll automatically get an email tomorrow morning to tell you how to log into the session here for the morning. So with that, thank you so much. What I'll do at this point is I'll open this up for Q&A. If you have any questions, there's a Q&A section and there's a chat window. Please type your questions into the Q&A window. And We only have a couple of sessions here left before the end of the year, but this is the last educational session. So if you're not joining us tomorrow morning, if you're not going to join us for our last market outlook session on Tuesday, I just want to wish everyone a safe and happy holidays. I know this has been a tough year, but looks like we're starting to turn that around here for 2021. So a lot of, I would say, bullishness going into 2021, a lot of optimism to 2021. So I just hope that everyone has a safe holiday, and I'll see you guys here in the new year. Otherwise, I'll still see you guys tomorrow morning on CNBC tomorrow night, and again Tuesday morning before we sign off here for the year. So let's take a look at some of the questions here. Paul, I mean, your question about IKBR, unfortunately, I won't be able to help you with that. You're going to have to contact IB on that front. Is the market overvalued, and is there a pullback in the future? I think I largely try to address some of those concerns about valuations and why I don't think just for those reasons you should pull back and short the markets. Pradeep, if you have an e-options account, so no, you will not. You have to sign up separately for an OptionsPlay membership. Can you look at EWJ? So Manny, that's what I'm doing for the rapid fire session tomorrow morning. So please submit your symbols, especially if you're a member, submit your symbols, and we'll look at the symbols that you submit for tomorrow morning. Kamal, Tony, please comment if time permits. Nike earnings come Friday at 4 p.m. I've never seen aftermarket close on Friday. So, okay, so Kamal, this is one thing that I do want to bring up, because I've recently had someone bring to me an example, and this is something I actually did a short video on, and we're going to be releasing this in just next week or so. When a stock reports earnings after Friday, and you have a position that expires this Friday, that is a big risk, because a lot of times investors only look at where does the price close on Friday to determine whether or not they're going to close a short position or not. But because the earnings announcement can move the markets after the close, you can actually get assigned even if your call or put expires out of the money, if the person who's on the other side expects that the call or put will be in the money on Monday morning. So, the recent time this happened was on Biogen. It closed on Thursday at 3:30 when the stock was halted. Someone sold like a 290 put or 300 put and didn't do anything because the stock closed at 3:30 and they didn't think that they needed to do anything. But over on Friday after the close, the FDA announced that they were going to not approve the drug, and the buyer of the put knew that, exercised their put, because they were expecting that the stock was going to open significantly lower than the strike price that they had, but the seller didn't close their position prior to expiration. So the seller effectively got put the stock at $300 and opened at 230 on Monday morning. So be very careful. I didn't know that Nike reported earnings on Friday. I mean, that does sound odd. It usually don't see big name stocks like that report earnings. Let me just check real quick. Nike reports earnings. Yeah, on the 8th. No, it reports after the close on Friday. Yeah, that is quite odd. So be very, very careful. It's, even if the stock expires out of the money on Friday, that's not what matters. What matters is where can it open up on Monday, because that will determine whether the person who sold you that call will exercise their call or not. So be very careful, Kamal. And I hope that this is a learning lesson for everyone, because this was a tough learning lesson for one investor who lost a lot of money selling put options on this stock, only to find out that on Friday morning that they and this person could have gotten out of the position also, had the opportunity, but didn't know that. So be very, very careful. You did well to talk about a pullback, as in February markets was an extended wave 5, but seldom does anyone call a black swan event like COVID-19. Yeah, so impossible to call that, right? There was no way anyone could have possibly called COVID-19. Michael saying, interesting that WD Gannon, his algorithm, early predicted 2020 as a panic year. I don't know anything about that, so I really can't comment. Where can we find the volume options traded for each stock that have options to be traded? I'm not sure I understand that question. If you don't mind clarifying, I'm happy to try to answer that question. Tomorrow's quadruple witching. Do you need to be prepared somehow? So this is a common misconception that I think people have about quadruple witching hour. There's been no research, no evidence that quadruple witching hour is any more or less volatile than any other day. Statistically speaking, it's actually slightly less volatile than other expiration Fridays. So no, I don't think there's anything special that you need to do for quadruple witching hour. How does NDX technically look? So I think that's one of the things that we talked about here, is that it's breaking out to all-time highs. My expectation is that you're going to see a continuation into the end of the year. How is VIX related to options trading? VIX is related to options trading because it tells you how much volatility there are in the market. So if you're selling options, how much volatility, how much are you receiving in premium? If you're buying options, how expensive options are. So VIX gives you a reading as to how cheap or expensive options are as a whole. Is there an ETF that tracks VolQ? No, there is not. Currently, VolQ only has a futures contract, but they're trying to expand out the VolQ ecosystem. So I wouldn't be surprised if next year we do start listing VolQ ETFs as the futures are out there. So once the futures are listed, you may have some ETFs or ETNs rather that are listed off of it. With VIX given to sharp spikes followed by slow meltdowns, what's a good way to put some exposure of volatility in my portfolio? So, there's many ways that you can do that. You can trade VIX options, you can trade VIX futures, you can trade VXX, which is an ETF that tracks the VIX. So Mark, there are lots of different ways. It really just depends on what is most suitable for you from a risk perspective. If you look at momentum versus value in trading view, it seems that momentum, MTUM divided by VLUE, you're thinking that momentum is starting to, yeah, so there certainly seems to be a bit of a new higher high in terms of momentum here, right? So this is one day. The one thing about these types of value plays is that, from my perspective, if you look at the longer term trend here, we've broken below that 20-day moving average. We've come back to retest it. So if it can break back above that 20-week moving average, I would agree with you. But I think that you could start to see also this continue to move down. So this is a chart of momentum versus value stocks. And from my perspective, I prefer to look at the weekly chart here to the left-hand side, where we've seen this huge outperformance momentum to value. And then over the past couple of months, value started to outperform. It's come back a little bit in terms of momentum, but I think that this can continue to go lower. When does the national debt become a drag on the stock market? The national debt, I don't think is a drag on the stock market. It's a tailwind for the stock market. If you look at the national debt, it's a tailwind. It's a drag on the US dollar. And that's exactly what we have seen here, right? A major decline here in the dollar, and it's now accelerating here to the downside. But, cheap money is a tailwind for equities because companies are effectively borrowing money for free. They're issuing dividends, they're issuing share buybacks. Is that adding value to the economy? The answer is no, but it certainly boosts the stock market. I think you said the range for the VIX in 2020 was probably around 13 on the low side, 26 on the high side. VIX is currently around 22. Isn't 26 very low as an upside target? So we were over 40 in late October. Yeah, so I'm not saying that we can't spike above 26, but if you can see VIX, so when I say VIX was, between 12 and 22, largely before the pandemic, it doesn't mean that we won't get spikes above it, but spikes above it are very short-lived. But largely, 80% of the time, you'll see it between these two levels. So when I said between those two levels, I'm saying 80% of the time they'll be between those two levels. You will see intermittent spikes that spike above it, but they don't hold those levels. What is the yield of the S&P 500? So if you look at SPY, SPY yields quarterly dividend of $1.34. Why is it showing zero yield here? Let's see. SPY, I believe, is yielding just a little bit over 2%, 2.0 something. Let's see. It has a dividend yield of 1.47% right now, is the SPY's dividend yield. For all the users that ask whether this is recorded, yes, this is recorded, and you will receive a recording. Kamal, you know, those are some of the things that we expect to do. You know, those are some of the things that we plan on covering in 2021 in our members only thematic investment. But you know, I'm also not here to give personal investment advice. Isn't it difficult for banks to thrive in such a low interest rate environment? Yes, it is, but they are, you know, interest rates have risen quite a bit from the March lows. That's part of why they have started to take off. But also just the fact that, you know, as economic recovery starts to take shape, they will also start to recover. What's your view regarding silver and gold? You know, my expectation is that dollar is going to continue to decline, and that's going to put a bit of a tailwind here for gold and silver. But, you know, gold and silver have had such a big run here to the upside. You know, I don't know how much higher it can go, but I certainly think that I'm more bullish than bearish on gold and silver. Wallace, for those of you that have asked questions about TradingView, I'm actually going to show you tomorrow morning how to access TradingView. We've recently entered a new partnership with TradingView, so we want to be able to show you how we can use. I want to show you how you can set up your charts the same way I set up my charts. So tomorrow morning I'll be going over some of that with you guys here. Thank you so much, everyone that wished me well, especially for the new year. Samir, thank you for your support. How do we access prior sessions? So if you go to youtube.com, or actually rather, oops. I'm just posting a link into the chat window with our YouTube channel. If you go to that page, that will give you access to all of our previously recorded. And we recently just put together a bunch of watch lists so that you can watch all of the different segments of the different types of content that we put out, whether it's webinars, whether it's market outlooks. You can all access that from this. When are you planning on releasing the unusual volume reports? I'm glad you asked me that because we are just putting in the final touches of that today. I can even show you what that report looks like here. So this is a report that we just generated today. We just started finishing up some of the formatting where we give you the symbol, we give you the, you know, what the average, what the unusual volume amount was. So for example, Broadcom traded roughly 26 times its average daily volume. And a lot of that volume, most of that volume was concentrated in the January 300 call options, which is odd for a stock that's trading at 425. And it traded 25 times more calls than puts. You know, Lennar, this is one that, you know, I brought up earlier this week on the Tuesday morning market outlook session. If some of you caught that big earnings announcement this morning, jumped up about 10%. Now trading at $80, which was my target price. I hope some of you were able to jump on that. That was a great trade. Trading 8 times normal volume here in the February $70 call options or $70 put options. Traded about 2 times puts versus calls. So this is the new unusual volumes report that we're putting out. So I'm glad you asked me that, Tyler. So this is something that we're likely going to be releasing, if not tomorrow, early next week. So we have both the unusual volume report, but we also have a straddle report. An at the money straddle report. This is another report that we are also putting out. This tells you where all the high value straddles are. So NEO, for example, if NEO was trading at $46, if you sold the $46 put, you're collecting $12.65. That's 28% of the underlying stock price, selling NEO or Palantir or Airbnb, you know, so a lot of these things that we are putting out. Are these reports weekly? No, these are basically updated intraday. These are updated, you know, the unusual volume is updated every 10 minutes. The Strata report is updated every hour. Like most of our other reports, they're updated intraday throughout the day. Jay, there was an email today that you would have received for the rapid fire session. It went out around 2 p.m. today. In that email, there's a link for you to submit your symbols for tomorrow. Jacob, your questions about electric vehicles. We're doing an electric vehicle thematic investment webinar in January. So I'm going to hold off on telling you about electric vehicles until that session. We're going to do a comprehensive view on electric vehicles and the specific companies within that sector. William, thank you so much. EA did work out. You know, it's a short play, but you know, I do think that it was time to get out. We made some money in just a few days, made over 50%. It's time to get out. What's your view on international emerging markets? So if you follow us on our Tuesday morning market outlook sessions, I've been pretty strong on emerging markets. If you've seen the devaluation we've seen in the US dollar, that's a tailwind for emerging markets. So I'm very bullish on emerging markets, especially if you look at their exposure to the Asian countries and the specific sectors that EEM gives you access to. I think EEM is going to be an outperformer here in 2021. Philip, what are my favorite technical indicators? So Philip, we actually recently did a technical analysis report for our members. So if you're a member, you can actually access that technical analysis report and the video that I did in conjunction with that. I talked about, you know, what are my favorite technical indicators. So you can send us an email if you want, if you're a member, and we'll point you to that report and that video. Can I get S&P 500 index evaluation on your site? So Henry, you're going to be able to do that through SPY. Eduardo, what about debit spread spreadsheet that you were supposed to add on to the program? So Eduardo, we explored the debit spread spreadsheet, but we decided against it simply because debit spreads, you know, the reason, and I explained this a few times ago, but just to explain again, you know, credit spreads you can sell when you're neutral or slightly bullish or slightly bearish. But debit spreads you should only buy if you have a very strong conviction of a directional move in a short period of time. And that's not, you know, even if I find really cheap debit spreads, it's not a good reason to go out there and buy them just because they're cheap. You still need to have stocks that you believe have strong momentum. And that is what we don't, you know, there's no algorithmic way that I can just show you all the stocks that we think are going to make a big move. So for those reasons, we're not going to be publishing a debit spread spreadsheet. Concerning your financials, what are your views on Bank of America? So I don't have a view on Bank of America here at the moment. I like financials as a whole, but I'm not picking specific stocks at the moment right now. Are downside risks stronger during Christmas vacation? So, you know, markets are thinner. So if you do get a sell-off, they tend to get accelerated during thinner markets. But you generally don't see a lot of volatility around Christmas, in my opinion. Is there a way to find cash settle indices in Thinkorswim? There's really only a few left. I mean, there's SPX, VIX, Russell, NASDAQ 100, but there really isn't many cash settle indices that you can trade anymore, to be perfectly honest. Should I wait for the beginning of the year to get long? I don't necessarily know there's a big difference between getting long now versus getting long beginning of the year. If you're not long already, you know, I think it's tough to continue to pull triggers on long positions at all-time highs. I'm not a big fan of entering brand new positions at all-time highs. I think you have to be pretty bullish. And while I'm optimistic for 2021, I'm not an outright perma bull here per se, as I do, you know, point out here today, there are some significant risks, in my opinion, for the beginning of the year. What are my thoughts on the biotech sector? If you look at IBB, which is the biotech sector, recently breaking out above this 145 level, very constructive, broke out, came back to retest this level as support, and now gapped higher here. So for those reasons, I'm actually quite constructive here on the biotech sector. I saw a tweet about unusual options in the platform. Is that a new feature? So like I said, we were basically testing out the real-time unusual volume report. So yes, that is coming out, and that is something that we are publishing as of right now, and we'll send you the links here in the next couple of days. What index or ETF would you favor approximately a 1-year horizon? So Eric, I mean, I would never put all of my money in any single ETF, or sector. If you're going to put all your money in a single one, then you probably should just use a very broad-based index like the S&P 500, the NASDAQ 100. But I would still argue that you should probably diversify across multiple sectors and multiple indices as opposed to putting all of your capital in a single one. I would like to know your time frame used to sell call and puts, 1 week, 1 month, or 45 days. When we're selling a put or a put spread, it's always 45 days to expiration is the optimal one. But anywhere between 30 to 45 days is a starting point that you can use. What exactly happens if we don't close a credit spread by expiry? Do we get the stock assigned? So that only happens if the short call or put is in the money will you get assigned. Otherwise, the spread will simply expire worthless. Can you add new features to the portfolio section of the OptionsPlay, specifically the date on which the stock trade was taken or announced? You can find that at optionsplay.com/dailyplay. So you can find out when we've entered a position by going to that page, which I will post into the chat window. Any site we know the options trading volume? Well, any options chain will tell you the volume, but I'll be honest, the volume doesn't really tell you anything. So I mean, you can go to any options chain, will tell you the volume, but I wouldn't necessarily, I don't know what you necessarily would do with that per se. Calendars, what is the best time to close them? So Sanjay, you should think of calendars as, the core position of a calendar is a long call or a long put. That's the primary reason you're in the calendar. You're simply selling a short dated call or a put against it to offset the cost of that long call. As far as when do you close a calendar, you generally close it because let's say you're no longer bullish or no longer bearish on the underlying stock, or if you've greatly exceeded the neutral view that you have on the underlying stock, because calendars are generally speaking neutral. The question here about Peloton here, I'm not here to give personal investment advice on your positions. We can provide you with what are considered best practices if you send us an email, but you can send that through the platform by clicking on the questions ask us button, and we can provide you with what we consider as best practices. Will Tesla drive other stock down tomorrow due to inclusion in the S&P 500? That's a great question, Peter. There are a lot of concerns from investors that Tesla will create a drag on the S&P 500 because you have a company that has, number one, a very outsized weight for the S&P 500 that is trading at a very, very rich valuation. So if you have any type of multiple contraction, you could see a drag on the S&P 500. But remember, there are 500 other stocks in the S&P 500. So the fact that it is 500 stocks is a good thing, but there are some concerns from a lot of investors that this is going to provide a drag here for the S&P 500. Please consider implementing some moving averages into OptionsPlay. So you can do that, but we are in the process of adding a new charting package into OptionsPlay. So you can already add your own moving averages. So you can click on studies. You can add moving averages. So you can add the 50, you can add the, the 200 day. So you can already do that here in OptionsPlay. So you just click on the this little expand button here on your chart. And there's a button here for studies, and you can add that. Sanjay, your question about diagonals, if you have a specific type of diagonal that you like to trade, send us a question here through the questions ask us, and we'll answer your question there. I started trading primarily put credit spreads in this bullish COVID volatility regime, and I've had a lot of success. I'm curious of what my experience may be going forward as we enter a period of lower vol. Your experience will largely be the same. You're just going to collect slightly less income. TLT has seen some rapid swings. Can you speak to the swing range and potential trading strategies? TLT, I think largely is going to be range bound. This is partially due to the Fed's policy yesterday, that they are going to continue $120 billion in bond buying every single month. They're not buying long dated options like TLT, which is 20 years. But largely that's going to keep a bit of a lid here on TLT, continue to move much lower. I do expect a slower grind here to the downside, so a very slow grind. So I think what you kind of play TLT is more of a range bound play. So imagine if TLT kind of continues in this particular direction. As it gets to the top of the range, you sell a call credit spread. As it gets to the bottom of the range, you might sell a put credit spread. But that's how I think I would play TLT here in the short run, especially as the economy continues to recover. Is it true that the NASDAQ 100 is changing tomorrow? I haven't, is the NASDAQ 100? No, I don't think the NASDAQ 100. You think Peloton is getting, let's see. On December 21st, new companies are being added: Marvell, Match, OKT, Peloton, and Team, and Expedia will be bounced from the index. So it looks like the NASDAQ 100 is adding a lot of these names. So from my perspective, all of these names that are being added and all the names that are being removed are very small cap. So I don't expect to see any changes, at least from the rebalancing, if you will, from this. It's not like Tesla, Tesla is entering the S&P 500 as number 6. And Tesla is among some pretty big names, and that's why Tesla put, there was such fanfare around that. But these are much smaller names. But I'm guessing that you're likely going to see some front running in some of these names, just like you saw in Tesla for S&P 500. I think that's why you've seen some of these big moves here to the upside, and some of these names like Peloton, big names here to the upside. This was announced on December 14th, which was just a few days ago. Yeah, so most of these stocks have had a pretty big run up here, some front running, if you will. What do you think about Tesla's inclusion in the SPX? That's what we were just talking about. I actually think that you're likely going to see Tesla pull back after tomorrow. A lot of front running going into the event. And I think that you're likely to see near of a temporary top here for Tesla. Praveen, thank you so much. I really appreciate it. And I'm glad that you are, that you have found value in the options education and the market outlook sessions. Thank you so much. We're really looking forward to continuing that into 2021. And like I said, some of the big changes in 2021 is that, for those of you that are members, you no longer need to re-register for webinars, for events. You're just going to automatically be included in all of them. It's going to make your life a lot easier. We're just going to publish a weekly calendar, so you'll know what's coming up. You can choose to attend if you like, but you're automatically going to be registered for them. So you don't have to worry if you're registered for an event or not. Cher, thank you so much. I really appreciate it. I hope you have a great holiday. Does all of your YouTube member sessions are published publicly? No, YouTube members only sessions are only sent out to members. So those are not publicly available. Chris is asking a question, if you're on a free trial, do you still receive the daily play emails, or do they only go out to members? So if you're on a free trial, if you're still active on your free trial, you're going to receive every single email. Only after your trial expires do you stop receiving those emails. Are these reports available for Canadian options too? So currently they are not. We are working with the TMX on that. If you're interested in that, please don't hesitate to send the TMX an email. In terms of the fact that you would like some of these reports for Canadian markets, because they are currently in the process of evaluating some of these reports for Canadian investors. Can this credit spread take in any time? Sanjay, I'm not sure which credit spread you're referring to, so please clarify. Is the straddle report a short straddle report? Yes, it's for selling straddles. You could also use it to buy straddles. So as you can see, the at the money straddle report, we have straddles that are extremely expensive, which are good for selling. And then we also, if you go to the bottom of the list, straddles that are extremely cheap, which in theory could be used to buy. So you could potentially use it for both. Raymond, you're very welcome. Thank you so much. Rodney, that is something that we're currently working on for 2021. I don't particularly have any strategies for Tesla because of the fact it's being entered into the S&P 500. If you were long Tesla for the past few weeks after the news was announced, you certainly would have done well. But now that it's being added tomorrow, I don't think that there's anything particularly to be added. How do I trade VIX? You can trade the futures, you can trade the options, you can trade the index options, you can trade the ETF, VXX. There are lots of ways that you can potentially get exposure to the VIX. Philip, I don't even know what I'm going to be talking about on CNBC tomorrow, so unfortunately I won't be able to tell you in advance. Alan, thank you so much. I really appreciate it. The straddle report and the unusual volume report, like I said, we just finalized it today. So probably early next week, Monday is when you'll start to see this report tomorrow on Monday morning. What are the 3 moving average lines you have on your charts? It's just one moving average line. It's just the 21-day moving average. And I put an envelope around it just so that it's not a single line. It's more of a zone rather than a line. On a vertical put spread, what that of profit ratios the minimum usually do? So I guess the question, Patrick, is, are you talking about a long put spread or a short put spread? Is it a credit spread or a debit spread? If you could clarify, I'm happy to answer that. It should have an S to ETF with that last question. Didn't mean just one. Was curious your top ones. Oh, Eric, good question. This is some of the things that we plan on tackling in 2021 is thematic investing, because when we look at our opportunities in 2021, the big ones really come from green energy, comes from emerging markets that we're looking for, everything from electric vehicles to renewable energy to some of our top picks for 2021, and we're going to disseminate which ETFs. We just covered cybersecurity, so HACK and CIBR are the ones that we typically look for within cybersecurity. So those are some of the themes that we plan on tackling in 2021, and those are some of the ones that we like for 2021. Hi, Tony. I cannot see where to access the volume report you just talked about. So it's not available yet. I was just showing that to you. We just finalized that here today. Like Teladoc related news, Amazon is going to start something in the same healthcare space and other companies going as well. Do you send alerts if something has changed fundamentally due to the news or the trade that you suggested? We'll always send you closing reports. So, Teladoc, the reason that we're short Teladoc is because of the fact that we see a lot of entrants into this space. It's an extremely crowded space. Even though Teladoc is the #1 provider in this space, it's a very crowded space. And those are the reasons why we're short this particular stock. Now, we won't send you any updates just because some news comes out. We will send you an update if we're closing the position. Chris, thank you so much. William, thank you so much. I really appreciate it. And yes, I was on Options Insider Radio earlier this week. I'm glad some of you were able to catch that. One thing I liked about the service is that if I had taken the account of all the trades, calculated ROI around 18%. Sanjay, thank you for calculating that. I'm glad that you've had success with following our trades this year. Thank you so much for sharing that. Sanjay, and also how many times, and about how many wins and how many losses. This is too honest about it. Sanjay, well, we are very transparent. We tell you exactly every single trade that we make and which ones we make money on, which ones we lose money on. Have a great holiday. With your help, I have made enough money on Peloton to buy one. Oh, thank you. I'm glad to hear that. You know, Peloton was one of the best investments I will say I have to make personally for my health, and it's been a lifesaver during COVID. So I'm glad that you were able to buy yourself a Peloton from that Peloton trade. That's quite the message to end the year. Thank you so much for sharing that, Chris. Is the dark pool data always available, and when can you find it in the tool? So Dave, I'm not sure what dark pool data you're referring to. But we don't look at any dark pool data, nor do I think that's very useful, to be perfectly honest. What is the upward arrow on the chart in OptionsPlay? The upward arrow refers to a trade idea. So when you have a trade idea, you're always going to get an arrow on the day that the trade idea was generated. It just means that the trade idea was generated on this specific date. And if it's a green arrow, it's a bullish signal. If it's a red arrow, it's a bearish signal. Any observations on Bitcoin? Yeah, I've been talking about Bitcoin for quite some time now, and I was saying that when you get the breakout above the all-time highs, that would generally put us significantly higher here, because you basically have had a very long-term, so you've had this initial hype up to 20,000, a very long protracted kind of decline, and kind of basically a repricing of Bitcoin. And now the fact that we've broken out above that all-time high, I think puts in a much longer term bullish view here for Bitcoin. So if your views are long-term, I think that you have some interesting upside here for Bitcoin. In the short run, I do expect that you could potentially see a pullback into the $20,000 range. And that's where I think is a buying opportunity. Credit spread sheet would suggest all the spreads. Sanjay, so the credit spread sheet is up to every single hour. So those ideas are fresh, so they're never stale. So yes, first of all, you need to do your own research on top of it, but all of those ideas are fresh and they are valid for the time that you see the report. And all the reports, the credit spread report, it's, as you can see, it has a timestamp. So you can look at when it was last updated. So always check that and make sure that the timestamp lines up with your the recent time. Just make sure that the timestamp is recent before you place any trades. Henry, kudos on the site's cover call recommendations. Even in this up market, almost all have closed profitably. Good education video on as well. Henry, so this is exactly why, when I tell you to sell cover calls that are really far out of the money, it's for this very reason. The goal of cover calls is not to generate a high amount of yield. If you go for high yield cover calls, you're going to get called away all the time, and you're going to lose out on that upside. You're going to be pissed off. Don't do it. Sell cover calls that are far away. Thank you so much, Henry, for sharing. Any webinars on how to trade straddles? So that is actually one of the topics that I plan on covering in January 2021. So look forward to the educational sessions we're doing. And we're doing it because we're launching that At the Money Straddle report as well. On the short put spread, what is the minimum profit ratio is worth considering? We usually try to take profits at 50% of max gain on a short put spread. With a bull put credit spread, what deltas are you looking for? We're always looking to sell about the 50 delta and buying back the 25 delta on a bull put credit spreads. Where and when is the Options Insider Radio? So it's actually a website, Options Insider Radio. So I'll just post a link into the chat window. I was just on this Monday. Let's look at this. If I'm not mistaken, this was the options block here. It was this one.
I believe that's one that I was on. Nope, that's from December 10th. Where is the one that I was on? I'm gonna have to find it, but I thought I was on the options block, but that doesn't seem like, oh, here we go. This is it. This is the one that I was on. I'll post that link into the chat window as well. So for those of you that like podcasts, you know, this is one that is just on options, very focused on options. They do get into a lot of nitty gritty stuff. So if you like that kind of nitty gritty, getting into the weeds of options and volatility, great podcast to follow. When putting on a multi-leg options, can you please discuss the change in overall gamma and how it relates to potential swing? So Barry, the multi-leg part has nothing to do with gamma. Gamma is just really something that comes into play as you get closer and closer to expiration. This is part of why we roll our credit spreads 2 to 3 weeks out from expiration, is to avoid that gamma risk. Gamma just means that delta is going to get a lot more sensitive. So a small change in the underlying stock price will result in a big swing in terms of your P&L. And as you get closer and closer to expiration, that swing is going to get larger and larger and larger. So that's what we refer to as gamma risk. Okay, with that, that covers all the questions that I have time for here today. I really appreciate everyone for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding as to wrapping up this year and what our expectations for next year is going to look, what our expectations are for next year. I look forward to seeing, for those of you that are members, tomorrow morning on our rapid fire session. And again, we will have one last market outlook on Tuesday before we wrap up for the year. So thank you so much. Have a great evening. We'll send you out the recording as soon as we finish here today. Have a great night. I'll see you guys in the morning.